back to bull call debits. Let's take a look at your second one. So if you have any follow-up thoughts on that, Rick, he says, yeah, okay, that sounds great. I got it. But let's go to your second part of your question. That covers longer term versus shorter term in time frame. Take a pause for a moment, because what I wanted to discuss here, we've been talking about in the money positions. Here's Marvel at 73.62, selling a 67.5 in the money call 35 days out in time, buying the 65. What are we looking at? 75, 83, 77, 80, 95.5% theoretical probabilities. The stock will remain above the short call strike price. We'll exercise the long to deliver the short, take the full profit. Of course, you can close it early if you prefer. But again, you've heard my sentiments and what my experience in that has been. It did not increase my success rate. Now, 35 days, or maybe I go 65 days. Let's keep it the 35 days. We'll go with Semtech, 35.84, sorry. Selling the 32, about 10%, a little bit more than 10% in the money. And buying the 30, 77% probability, return of 21.2%. All right, so go to the profit and loss chart. What do I mean by 22%? The max profit is 35 cents. This is going to be entered at a debit of 165. Selling the 32 call at 465. Buying the 30 at 630, 165 debit on our 2-point spread. So the maximum profit we get back at the stock's at 32. We get $2 back, so we make 35 cents against a true risk, our true debit of 165 at midpoint prices, 21.2% return. What is that mathematically? Just like on a high probability credit spread that we were looking at, I'm looking to make 35 cents to risk 165. So it's not quite, but we're looking at a 5-to-1 risk-reward ratio, if my math is correct, this Friday afternoon. Strike that, reverse it. 5-to-1 risk-reward ratio, or 1-to-5 reward-to-risk ratio. So that the 14% returns I was showing, Rick, they're closer to an 8-to-1 or 7-to-1 risk-reward ratio. And everyone who looks at those ratios says, okay, Mike, well, on your credit spread that was 35 days out or 14 days out on a 2-point spread, you're taking a return that's only 14%, and that comes out to a 7.5, 7.6 to 1 risk-reward ratio. You lose one trade, you've wiped out 8 previous winners. Unless you have that 80% success rate, really you need 85 or higher, which we've been getting, you're not going to be successful. And I'd say you're right, which is the imperative part of controlling risk to only half of the loss on the ones that do go against you. You can't allow them to take full loss. 5-to-1 is not too bad, right? The 5-to-1 risk-reward ratio here that you're seeing on this particular position for the 20% return with that 70, 75, 77% probability, I believe it was, is not too bad. But again, you lose one trade, you're wiping out 5 previous wins. You're going to need that 75, 77, 80% success rate to stay profitable long term. So the idea that comes across, Rick, where you came across this, if it was someone who was teaching it or if something you read somewhere, the idea was that, hey, if you think you've got good stocks, I don't know if Semtech I'd consider a great stock. I've never tracked it, never traded it before, just being upfront. With the stock at 35.86, and I'm saying to myself, I don't like this 8-to-1 risk-reward ratio. I'll never be profitable. I don't like this 5-to-1. I'll never be profitable. One trade's going to wipe out 5 previous trades. I'm going to need an 80% success rate just to make break even. But again, we're not going to allow it to take the full loss. That's not the full story. And so here comes the idea, is that I can do much better if I even say 35 days out in time, but people that do this usually go 60 to 70 to 80 days out in time. I'm sorry, wait, 35.86? Yeah. And what I'll do is instead of doing the safe in the money higher probability debit spread, I'm going to sell the at the money 36 strike, buy the slightly in the money 34 strike. I'm going to get about 210, hopefully at midpoint, 215 at midpoint maybe, and I'm going to pay around 280 or 290 here on the debit, on the buy. Yeah, 295. Let's just round this to 220. We'll give ourselves favor. We'll give us a nice price here, okay? So now what do I have? I have a 2-point spread. The 75, actually, let me go back down to 215. I'm sorry, folks. I'm sorry. I should have left it there. Yeah, that's more realistic. All right. So now what do I have? I've got a 2-point spread that I've only paid a debit of 80 cents to get into. Means if the stock's above 36 in 35 days, I'll get 2 points back, so I'll make a profit of $120 or a 150% return. The allure of this naturally is the mathematics behind the concept of we are closer to a 1-to-1 risk-reward ratio. In fact, we've skewed it a little bit more. We're at sort of a 1.5 return to a 1 risk. How can you go wrong? Well, remember at this point, you probably only have a 41 or 42% theoretical probability that the stock would be above 36 in 35 days and you'd make the maximum profit. So what investors do in this case, Rick, is they start off and say, I've got closer to this 1-to-1 risk-reward ratio, which means I'm going to be at 100, 110, 90% return if I get the max return in 35, 45, 60 days. But if they reach any point in this trade where they can close this position for half of this profit, well, that's still roughly a 50% return, isn't it? In that case, if I'm risking, I'm sorry, the max profit, the max profit of 1 I did that wrong. Scratch that. If I make 50% of my expected return here, which would be 60 cents, well, I'm still making double-digit leverage return. Now, I'm going to take it out off the table as soon as that happens. That's the at or sort of out-of-the-money bull call debit spread approach. And that's why they're using it further out in time. Even though the time decay is slower in your favor, they are hoping that they're bullish in the short term. But again, this is when I would look to close the position early. If I have a good in-the-money position with a 21, 25, 30% return with 70% probability we looked at for the 30-day out, 35-day out positions, or I'm looking at that higher probability 85% shorter term for a 14, 15% gain, I'm playing as close to the vest and as close to expiration as possible to get that maximum profit to meet my trading goals. This is an idea where you can make your trading goals with lower probability, but you're always looking to close the position early anytime you hit 50% of the expected max gain on the position. That's where I think this came from. And what I've been talking about sort of equates to your second part of your question, but your second part of the question is a little bit more involved. But I want to pause here for a moment to say 2 things. Number 1, you want to see further ideas about the bull call debit spread in the money versus the out of the money. Well, you can take a look at the more in-depth presentations I mentioned on our playlists, on the Power Options YouTube channel, in the money versus out of the money bull call debits. And at the same time, if you're interested in that kind of approach, in the sample searches, not the main search, in each strategy of the main search, and then you have other themed searches under sample searches, under bull call debits, you've got the out of the money, out in time bull call debit spreads, 60 days or more out in time, low probability of success, but looking more for that 1-to-1 risk reward ratio. 2.5 point spread here on Southern with a $1.75 net debit. That's a little bit low, but here, Dell, 140, 135, 5-point spread with a 235 debit, close to a 1-to-1 risk reward ratio, which would give you 100% return. You can use these as a stepping stone to create your own personal search following if you're interested in going with that at or just out of the money. So again, go to bull call debit, go to sample searches, select our default theme search, OTM out in time bull call debits, and then just tweak the option criteria, probability, minimum percent return. That should really be at about 55 or minimum. Probability range, as I mentioned, debit, and then what other factors you want. Stock in an uptrend, broker recommendation, MACD signal, earnings per share growth. This one usually does cross earnings, as you can imagine, Rick, between now and expiration, but you could also check that to it. When I do the in the money ones, I always avoid earnings between now and expiration, especially with that bull call debit spreads. But that's a starting point. One quick thing I want to do before I get to your second question, heading over to radioactivetrading.com, where we talk about our married puts. And don't worry, I'm not going into a married put discussion to hurt everyone's brain as we're talking about credit spreads. But there's a tool here that I want to use. I'm going to go to resources, and we're going to go to the trade simulator tool. And what this tool does is you can put in your expected starting amount that you do, let's just put in $10,000. And, I'm going to say I open 3 trades per cycle. So I'm going to allocate 33% of that 10,000 to each trade. For the higher probability out of the money bull put credit spreads, which would be a parity trade to the shorter term in the money bull call debits, I said I was seeing an average around 14.9% return. I'm going to mitigate my losses to 50%, the loss limit I'm going to allow to take of what's invested. That's already determined here, $3,300 into each trade. But my probability of loss, reverse of the probability of success, but my probability of loss, we're going to leave it 15%. It should be really 14, but I'm going to leave it at 15. And there we go. So 85% wins, 15 losses. At one point, taking the 10,000. So I'm sorry, what the tool did, let me explain that. It flipped the coin 100 times. Heads, we win 14.9%. Tails, we lose 50% of the 33% of what we had in our portfolio invested in the position. At one time, we almost went up by a factor of 10. But at the end, this is about what I'd expect to see after 100 trades. But I do also expect to see a 25 to 26% drawdown. Even within the money bull call debits, Rick, with that 75, 80% probability, whether you're 14 days out, whether you're 35 days out, you will experience a drawdown. In some cases, it might be as high as 45%. Okay? Now, why I'm here is not to wow everyone and say, oh yeah, go ahead and do this, you'll be successful. Remember what I said, there are times when I don't enter the bull put credit spreads or the bull call debit spreads. Right now might be one of those times when we go back and take a look, that market sentiment tool. Now this is random each time, but I'm going to try to get to it. Here's what you see, the potential outcomes with this structure, with limiting the losses to 50%. Meaning that if I had, what did we take in? I'm sorry, it was 36 cents on a 250 spread. So the risk was 214. If that loss, my cost to liquidate the position hit 107, 50% of the maximum loss, I'd be out of the position. I'd close it. Wouldn't try to manage. We're going to get to that in a moment, Rick. But I'd close it. So why do I keep harping on this 50%? What if I just allowed it to go to 65%? Wouldn't that mean that a couple more positions could go beyond that, go above the 50% loss, but I'd stay in them and eventually they'd come back and I'd have a higher success rate by just allowing it to go up to 65? Why let some of these others be stopped out? Shouldn't this go up to a 90% or 95% success rate because I'm allowing more losers to happen before they recover? No. But important here is, let's try to get those same numbers. Now it's random each time, so give me a moment here. I want to get to 85 and 15. And the numbers do also depend on the randomness of the win-losses in a row. Come on, 85. 86 is close. We might use that one. There it is. Remember what we saw. And we have 2 losses in a row here, which does hurt. But we also had 2 losses in the first 4 on the first example. 85 wins, 15 losses. Allowed the losses to go up to 65% with the same success rate, the same return. Almost a 40% drawdown in the portfolio as opposed to 23. Never hit that tenfold, but we did have about an 80% profit, but we end up with half the money, less than half the money we would have seen by controlling the risk to 50%. Let's take it up to 75, allowing the loss to get near the full maximum loss of the trade. And there we go. You lose $2,700. Same success rate, same win target, same starting amount, over a 50% drawdown at one point, which you probably would have gotten out of the strategy at that time saying it's not going to work for me. This is why it's important with these leverage positions, whether you're looking for those 30-day out bull call debit spreads that are in the money, with that 75% probability and that 25, 26% return, Rick, whether you're looking at shorter term weeklies or 2-week out positions with a lower percentage return, higher probability, it's an 85% range. You just saw the math of why it's so important to control risk in these leverage positions. Even if you're doing the one-for-ones or the at the money one-to-one risk reward ratios, you're planning on closing those for half of the expected return. They also plan on closing those positions if they hit half of the expected loss, because you can't do that as a counter. It will take your money away. And that's what you're seeing right here. 85. How can I lose money if I've got an 85% win rate? Because if you don't control the losses, This is the lie of leverage working backwards. Everyone says, hey, it's great to use leverage. Why buy a stock or why do a covered call that makes 3% investing thousands of dollars? Why don't I just do the bull call debit spread? Why don't I just do the bull put credit spread? Because you can risk 100% of what you invested in the trade, and you cannot allow that to happen. So those people that tell me, Mike, your spread search, I don't like your bull put credit spread search for the weeklies, it's terrible. It's an 8-to-1, 9-to-1 risk reward ratio. It's not going to work. And I'll say, you're right. And this is the proof of it. If I don't control the risk, that is the next step that you have to do. It's not just about the perfect criteria. It's not just about the perfect structure. It's not just about the perfect probability. Every one of these is going to require management where you can't let the money get away from you. You got to cut those losers short and let the winners run the full expiration, as we, to use the cliche. There we are. So I know that was longer than you wanted to go into that first part of your question. But again, let's just reset the question very quickly and cover what we covered. In your experience, any value in buying bull call spreads in the money longer term and closing them early versus shorter time frame? I'd expect you to see the same success rate, but again, we're talking about why would I add that extra step for myself if in 14 or 30 days I can hit the target returns that I want with the probabilities I want without the extra step of closing and keep the same probability. In my experience, the success rate has not increased by closing the positions early. The ones that go against you still go against you before you hit that desired closing early target of 25%, 40%, or 50% of the maximum profit. That's been my experience personally.